We hear a lot of stories about, we are early in the recovery and the cycle, and the recipe book is telling you to buy value. We would caution on this. PIMCO has pointed in his secular outlook that we are in an era of disruption, and a lot of things are changing. Things were already on the move before the pandemic, got accelerated by the pandemic.
The first was technological disruption. And certainly over the last few months, we've seen traditional working patterns and office environments really be upended from the work from home environment. Secondarily, populism. And certainly with the COVID crisis exacerbating income inequality and disparity across many of the developing countries and developed world as well. Third is environmental concerns. And certainly over the last few months, there's been a particular focus on the integrity of the food supply in emerging markets. And then lastly, we've seen a real push towards monetization of fiscal deficits. Now, all of these structural impacts are really set against an environment where we expect that the global growth backdrop over the next couple of years is going to be very low. And we do think that central banks will respond very cautiously. In terms of the market impact, we really would distinguish between the short-term dislocations that we saw emerge in the first and second quarters this year versus the longer-term, more structural impacts to the market. We're more keen to like those investments where we think that there's short-term dislocations, where the liquidity provisions put in place will continue to heal those assets and continue to allow those assets to return to fair value, versus where we think there's a real impediment given the solvency risks that have emerged.